Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for January 15th of 2023. See our disclaimer for important information. Well, as we get started today, I want to revisit about 2, 3 slides from last week to really just underscore the difficulty that investment management was last year. And this will be the last time I show this, but I've had some folks kind of request to see this again, just kind of underscore, the state of affairs last year. If you look at commodities, we're up 16%. Cash was up slightly as we had rates increase, but everything else went the other way. We had S&P 500 down around 20%, so equities were down quite a bit, and then fixed income was down quite a bit too. The Barclays aggregate bond index was down 13%, and as we'll see here in a second, that is an extremely unusual environment. As we see here in this chart, again from last week, the unusual nature of the market, and we have to go back to 1872 to find a time where the S&P 500 equity index or its equivalent and the 10-year U.S. Treasury lost more than 10% on an annual basis in terms of total return. And you just think about how profound that is. You think that's 150 years ago that we have to go back to see the kind of percentage environment that we were dealing with this past year. And this is a scatter plot, just so to kind of level set here. So you've got 10-year Treasury on the x-axis, and you have S&P 500 on the y-axis, and then so most occurrences you're going to see here are to the right and up, which represents an environment where both bonds and stocks are positive, and that is the majority of the time. Every once in a while, you'll find stocks or bonds be negative, but generally speaking, you'll see the other one be positive. And so if you go to the lower left, that shows you the few handful of times that we have had this environment that we had to put up with last year, in which not only stocks and bonds negative, but obviously in the case of last year that they were negative by quite a bit. Here is a chart which kind of shows the same data, but since World War II. And you've got to go back to 1969, and you think about that, that's like essentially at least 50 years ago, to find an environment that was comparable to the current one. Again, we're dealing with the quadrants here, and so lower left is not where you want to be. Stocks and bonds were down, and just to re-emphasize the point that more often than not, you see those scatter plots on catty corner here, they're on the right and up, reflecting an environment where both stocks and bonds are positive, and you get the benefits of that diversification that we always talk about in financial planning. Here's a study we see from BlackRock on what the damage could be if the Fed continues on its pace of rate hikes. And again, the current consensus now is that the Fed's going to raise maybe a couple of more quarter point increases, and then we get up to around 5% on short-term rates, and then they kind of pause for a while. We'll see this a little bit later, that's exactly where the Fed expectations bar is set. Now, the market is a little bit different. Market feels like rates are going to come down. We'll see that in a second. But this chart is trying to analyze what's the impact on economic growth from these rate hikes. And again, you could get 5 different studies and you'll get 5 different answers. This one in particular just happens to suggest that the negative impact by mid-year on economic growth will be about 1.75%, meaning that these rate hikes will cause economic growth to fall by 1.75%, and then that impact goes away over time. And this is kind of all part and parcel to my theory that we have the 6 months of increased volatility, and then we begin to get clarity on this stuff, because whether or not you believe this, and maybe maybe the impact is not 1.75, maybe it's 1.25. Again, anything over 2, 2.5, 3 is a major negative event. But I think this one's not suggestive of like a real cratering in economic growth. But the timeline, I think, is important. So if we can persist with volatility as we head towards the middle of the year, then I do think the clouds will part and we'll have more visibility to the second half of this chart, which shows that impact goes away over time as we get into the out years. One of the more interesting numbers last week was the CPI inflation number. Obviously, we've been hanging on this thread for many, many months now, watching the data kind of improve ever so gradually. You can see in the aggregate, inflation still remains really high, but it is trending in the right direction. Here we have a plot of the overall inflation number in the gray line. It was up 6.5% year over year, even though the monthly number was actually negative 0.1%. And we've got the core number here, which is essentially the overall number less food and energy, was up 5.7%. And so basically the data that we got with regard to inflation last week was pretty much exactly in line with expectations. And so sometimes when that happens, the market has a little trouble kind of digesting it and kind of making sense of what to think, because there was no surprises. I happen to think that it's a positive surprise because it reaffirms this trend that is clearly at play here, that inflation moving down. And I think as we get into some of these later slides, you'll see where I'm coming from when I say that there is a chance that we could see some very interesting positive movements in inflation throughout this year. Well, and looking at some of the internals, we'll start with goods and services CPI, and it's overlaid with the core CPI here, which we know is moving lower. On the left-hand side, you see in the gray area, goods inflation has gone down now, and that's very consistent with an economy that's not accelerating, and so we expected that. But what's interesting here is that service-related inflation, as the economy, as we kind of got past this whole COVID-19 thing, and we have this consistently re-emerging economy. Obviously, that's not the case in China, but it is here in the U.S. and most of the developed world that when you reopen, you see that service inflation move higher, and it's consistently moving higher. And you see the offset here with goods inflation being moving lower and service inflation moving higher. The net effect of that is that the core CPI is like rolling over a little bit. And so, what we're going to have to pay attention to in the coming months is what happens to that service inflation. But if you think about what goes into that, again, wages primarily, I think there's a case to be made that wage growth we see that slowing, and we have charts on that this week that, as that slows, then the service inflation, I think, is inherently going to go down. Now, on the right-hand side, you've got a few things that I think are important to inflation. Certainly important, in terms of maybe psychology, perhaps. But some might argue that airline tickets, if you had to travel over the holidays, maybe didn't drop like that for them. But overall, I mean, this is the data right here: gasoline, used vehicles. We have a chart on that coming up. That some of these kind of key issues that were really high last year are not an issue right now. Now here is a look at wages, and you can see regardless of what the income cohort is, they're all moving lower. I think this is something that obviously the Fed's going to have to pay attention to, because wages are extremely important to overall inflation, and we'll see like housing and shelter later on. You think about areas that tend to be sticky in inflation. Wages are certainly that way. You can see in the aggregate, year-over-year growth is still pretty high, but it's trending in the right direction. And the market loves to take signals, right? And they hate surprises, and so this is a pretty lazy trend downward, but it is a trend, and it's one of the smoother economic data lines that I've been looking at. You can see that there's consistent month-over-month trend in this. Now, that's not to say that it won't abate, and and turn course, but I really don't think so. I mean, labor market's in pretty good shape. There's a lot of mobility. There's still 1.5 jobs for every unemployed worker, primarily in the service and the low to mid-skilled areas. You have an unemployment rate. We've got a chart on that that's really hugging this long-term trend line. Labor market's in pretty good shape, but you're just seeing the froth come off of wages right now. And here's a quick look at vehicles. This is psychologically a very important data point, as we clearly saw in 2001, 2002, notwithstanding all of the supply chain choke points and other things which caused vehicles to be in short supply. Certainly on the used car side, we had a lot of rental fleets that liquidated, and then we're struggling to find used vehicles, and so prices kind of shot up through the roof. But you can see in both of these cases, new and used vehicles, the data is turning the other way. So when you think about, we saw that, and I kind of chuckled about airline tickets, but yeah, I mean, some of that was expensive over the holidays because of the flight disruptions and so on and so forth. But overall, you see airline tickets, car prices, you see some of these things move lower that were real sources of pain in the market just a year ago. Here we have shelter, and I want to talk about this for a little bit because this is an interesting dynamic here, and the data that economists look at and compile and make forecasts on is all backward looking, right? I mean, it's hard. The leading economic indicator, or LEI index, tries to do a good job of measuring, what would be, what we can expect like in the near term future, and then they also have the coincident indicators. But inherently, the data that we're looking at is backward looking, and we know that in terms of shelter costs, I mean, we saw that huge rise in home prices over the last year and a half. And of course, we see now that housing market is normalizing. It's beginning to look a bit like it should in terms of number of months of inventory on the market, so on and so forth. Well, we know that rents tend to lag home prices by about 9 months or so. And so, correspondingly, we saw home prices shoot up. We knew rents were apt to follow. And when you think about owner's equivalent rent, it's about 30-35% of core consumer price inflation. So it's very important. And again, you look at these charts, it's still high. It's like cresting, right? But again, this data is backward looking. And as we already know that home prices are moderating, we're going to expect rents to follow. And we already saw here that investment we'll see it shortly. Investment in multifamily structures is still moving higher. There's available credit out there, which is something you typically don't see at this point in the economic cycle. You typically see credit constrict, but now you see, banks are lending for people to build apartments, and so, we're still struggling to backfill and meet the demand. We had a decade of underbuilding in a lot of residential structures, and we're trying to catch up now. But again, everything moves at a lag, so this data should roll over at some point, and I think it'll be very, very interesting and important to the whole inflation picture as we get into the middle of the year. And kind of, to wit on that point, as we talked about that last slide, we've got an overlay in the purple here of the CPI for shelter. And, again, that's moving higher. We think it's going to roll over. But here's why. If you look at the red line, you've got average hourly earnings. We just saw this, that wages and compensation are decelerating. Again, they're still high in the aggregate, but they are decelerating. And this chart tells us that you have affordability issues because wages aren't keeping pace with rents. And I think this is a natural limiter to this whole housing price or housing affordability issue. And I think I guess to put it in different words, it's going to help moderate cost of shelter overall. in the coming months. And I think the astute observers are already kind of factoring that in. But I think there's a lot of people that aren't really paying attention to this that say, well, shelter's still high. But yeah, I think in the coming months, I think this is something that we're going to be talking a lot about. And I think it has the potential to really drive inflation lower than people expect. Well, as we kind of close out the chapter here on shelter, I wanted to offer this slide. You've got, three large research houses really corroborating on this particular data point. And esoteric though it may be, I think it's extremely important. We've been talking about this potential surprise, this positive surprise in inflation that could be in the offing in the coming months because of this transition of shelter cost inflation rolling over. But if you look at, if you back that out, if you take the consumer price index and you back shelter out of it, again, at the core level, we know shelter accounts for about 35%, a little bit less so in the all-in number. But if you back shelter out, look at this data point. I mean, we see deflation outside of that. Again, we know the overall CPI number for the month was negative by 1.1%, and but overall annualized inflation still 6.5% or 5.7 if you're looking at the core. But if you back out shelter, inflation's moving down already beyond that. And I think if you dovetail what's going on already in elements outside of housing with shelter costs moving lower, that I think really underscores the potential surprise here in the overall inflation picture. Certainly, I'd say like second quarter heading into midsummer. Now here's a chart from Alpine Macro, which kind of continues this theme of the potential positive surprise in inflation. What they're doing is they're reconciling all of these things that I've just been talking about, where you got wages rolling over and shelter, the two things that are perhaps as sticky as they come in terms of inflation. But they're expecting PCE, which is personal consumption expenditures. It's just another proxy for inflation that the Fed prefers to use, and they're expecting that to roll over. So we've had already a cresting. We're still at aggregate high levels, but they're expecting that to roll over. I'm not sure I follow through the end of this red dotted series, but I do think that inflation, which is right now expected to be maybe 5%. And you think about, it's 6.5% now, 5.7% at the core. If it falls to 5, that's not tectonic, but I do think that if we get the positive surprise in inflation, again, doesn't move down to 2%, not anywhere near the Fed's target, but if it moves down to say like 4%, I think that would be profound for the risk capital markets that will sense that. I mean, market loves positive surprises. It absolutely hates negative ones. But you could see money rotate, I think, rather viscerally back into risk capital assets if you saw that inflation number drop faster, because what it means is that the Fed is likely to stop its rate increases sooner. And that perhaps that you're a little bit closer. You may accelerate the timeline to get to that new market cycle afterwards. And here's a quick chart on the 2-year government bond yield, and this just goes back a month, and you can see a lot can happen in a month, and a lot certainly has. I'd like to think that most of the time you get to the holidays, Christmas, New Year's, that things don't tend to move too often. You got a lot of people that are out of pocket, and just a lack of volume. But you could see here the inflation theory was building throughout the month of December. You saw a pretty strong move in the 2-year government bond yield, and you see it peak there almost at 4.5%. And then we got the jobs report here this month, and we've talked about that a little bit. It came in pretty much in line, showing a little bit of slowing, kind of like basically what everybody thought it was going to do. And then you have the CPI report, and you can see how quickly things can turn around. So you think about this. I mean, we did, essentially about a 35 basis point round trip in nary a month, and that's, when you think about interest rate movements, that's huge. And so where we sit now is still over 4%. We still have an inverted yield curve, but we do have this building sense into the fixed income markets that we're going to have, we're eventually going to be transitioning to lower overall interest rates. I mentioned this a little bit earlier, but this kind of highlights the difference of opinion that I think the market has versus where the Fed is. And of course, you can see these rate increases. These are short-term Fed funds rates, which we know very, very, very well have been moving higher. And then where we are now is, we're likely to get, maybe a couple of 25 basis points or quarter point increases. We're about 4.5 now. Eventually, maybe we get up to around 5. That's what this chart suggests. The terminal rate on this rate cycle will be about 5%. Well, the Fed is apparently of the opinion that they're going to stay there for a while. We've heard a lot of Fed people out there on the lecture circuit talk about how they want to get to 5 and then hold, or that they anticipate being at 5 or greater for a while. Get that, the market prices that in, no surprise to anybody. Well, the market itself is beginning to price in that we'll actually have a rate decrease by the end of the year. In fact, beginning to price in that we'll have like a 0.5 point of rate decrease by the end of the year. And that is the recession theory, if you will. That's the pricing in of this recession, that the Fed's going to stall and then they're going to ease a little bit. This mild recession that honestly, if it does materialize, it will be the most anticipated recession in the history, certainly since I've been working in these markets. But again, that's not a foregone conclusion. You've got the leading economic indicators that are suggesting inflation. You've got the yield curve suggesting inflation, but yet you still have very strong, relatively strong employment. You have high national income, and you also have credit expansion, i.e. the banks are continuing to lend. And those are things that you almost never see if you are literally on the doorstep of a recession. So interesting divergence here. We'll have to see how it plays out, but we probably get a couple more smaller rate increases, and then we kind of hit a holding pattern for a while. Well, in fact, this is the chart that kind of confirms what the market's thinking right now. And you can see throughout 2022, expectation was building that we'd hit economic slowdown and then eventually rates would go down. And ironically, with some hiccups there, I mean, it's been a pretty consistent downturn since honestly the end of 2021. And we're at a point now where the market actually expects in the second half of the year, like I said, a 50 basis point or 0.5 percentage point rate decrease. Well, it was interesting in all of this conversation about inflation, coming down and where it's been, and the fact it was really high last year. The interesting thing is that the long-term expectations honestly really haven't changed that much. They've recovered from the pandemic lows, but they've been locked into a channel for years and years and years. And so what we're looking at here is the expected 5-year inflation rate 5 years from now. So it's essentially looking 10 years down the road. And you can see that this has been very consistently stuck in that 2 to 2.5, maybe 2.25%, just kind of in a broad range there. And that's exactly where we have recovered to, but we're not moving higher. So, as you think about the last, handful of quarters where we've been dealing with high inflation, it has not moved this chart really one bit. Interesting chart here where we plot core CPI and core PCE, again, personal consumption expenditures, two proxies for inflation, as you would expect. In the kind of the orange and the yellow, they're going to be tend to almost be right on top of each other. And then overlaid with that is the blue line, which is the effective Fed funds rate, or the EFFR. And you can see here with these columns of recession overlay, these shaded bars here, if you will, that you typically get, the Fed trying to respond to perceived inflation as maybe these, inflation numbers move higher. And so they raise interest rates, and then that tends to create a policy mistake, and they send the economy into recession. And, that has happened consistently. You can see here, just taking a short window here, like 98 to 2000, and in 2008, obviously there are other things at play there, but, very, a corroborated type of occurrence here. And so each time we had a recession, well, had that long upcycle, and then, rates were moving higher as the Fed was trying to normalize. And then we had the pandemic. That was an exogenous shock that really obviously nobody anticipated. But, you see rates moving higher. At the same time, though, inflation's not moving higher. Inflation is actually reacting as it does with a lag to rising interest rates. And so we've seen these tightening cycles before, but usually in a tightening cycle, you don't get a reaction in inflation moving lower in real time. And usually the policy mistake is that the Fed keeps raising rates, and then all of a sudden all of this tightening gets channeled into the economy, and everything really starts to slow down in a hurry. Well, what we're seeing right now is that what the Fed started to do last March in raising rates is actually transmitting through the economy into lower inflation. And this is why I say, if we get these positive surprises on inflation because of shelter, because of wages rolling over, if you get that, then that's going to be a strong signal to the Fed to maybe ease off the pedal a little bit sooner. As we were talking about earlier, the job market remains relatively strong. You can see that here. We're at the 2019 average, and really haven't really seen a whole lot of softening. We see hiring intentions rolling over a little bit, but overall employment is not bad. Quit rates are still high, so there's still parts of the labor economy where workers are still in control. Even though wages are rolling over a little bit, but you do see quit rates high, and there's still at least 1.5 jobs for every unemployed worker. This is an interesting overlay of sentiment versus asset positioning and risky assets. And so, you can see this relationship here. It tends to follow. So University of Michigan consumer sentiment is in this blue line, and it's heavily influenced by, anxieties related to inflation. It's just the way they ask the questions. It tends to flush out this anxiety and inflation. And obviously with the inflation numbers that we've seen and the shock value of it last year, you can see here clearly that sentiment has gone into the tank. Well, interestingly enough, the asset allocation to equities, even though it's come down, it still has remained relatively high to the sentiment number. And so, you don't see this divergence very, very often. You certainly don't see the magnitude of this divergence very often, but, I think that the takeaway by the people that, when I pulled this out of All-Star Charts, the takeaway was that something's got to give. Either sentiment's going to move higher or equity allocation is going to move lower. And I don't disagree with that, but I do think the sentiment will improve as inflation comes down, continues to come down, and that eventually set the stage for a better environment for equities. One thing that I think is going to be a theme for 2023 is Europe. And, we spent a lot of time last year talking about the impact of the Ukrainian invasion, the fact that Europe was standing in defiance to Russia, in support of Ukraine, and, then the rhetorical arguments both in favor and against whether that coalition would crack in in the wintertime. I showed you a graphic in the chart back last week of a ski slope in Switzerland that was bare. It was basically green grass all over, that they haven't had snow because the weather's been warmer. And so that's been a very interesting dynamic this winter, that it hasn't been cold. It's been, I mean, standards of deviation warmer than normal in Europe, which is almost kind of like a poetic justice to the situation. Anyway, notwithstanding that, the overall economy in Europe is in a lot better shape. And Germany being the largest economy in Europe, you can see here these up bars. In fact, their GDP looks better than the US right now. And that's not something that I think very many people would have expected this time, even 3, 4, 5 months ago, but it is clearly playing out that way. Here's oil production. So another one of these things that caused a lot of gastric discomfort, for consumers over the last year was gasoline prices. And, it fed into not core, but overall inflation. And again, it's one of those things that made people feel like they were personally in recession because they were paying so much at the pump and seemingly left with little, especially the lower income cohorts. Well, oil production has almost regained 2019 levels. And, to the extent that we can move that oil through pipelines and get it to refineries, even though refinery capacity is constrained to some degree, but obviously we're trying to increase that, and I think there's obviously an interest that we have in wanting to increase our energy exposure. As much as it was a real horse for the market last year, I do think there's a lot of staying power for energy as an investment in 23. And you've got production that's moving higher, even though that might limit price growth, but it does provide volume gains. I think pipelines and other things are going to benefit here, but it's good for the economy. It's going to help to keep downstream distillate prices like gasoline a little bit lower than what we saw last year, which is obviously good from a consumer standpoint. Another thing I've been tracking, container imports, and we already know the container pricing coming from abroad. Now these are 20-foot containers, container volume you would put on the on a large ship moving across the ocean. Well, we already know that these prices are back to pre-pandemic levels, but volume levels are coming down, which is kind of an interesting thing. I think it has a lot to do with waning demand for goods, which we know is already well underway. You see these bars that are above this trend line, if you will. It really represents what the pandemic did for all of us. Obviously, we couldn't go out to restaurants and shops, but we could sure order a lot of Amazon, and that's what people were doing, and they were ordering stuff. And that stuff came via container ship from areas across the globe where they were being manufactured in controlled environments, trying to protect people from COVID. But needless to say, that is rolling over. It's one of these subtle things that the Fed watches that I think it's a good thing for all of us. When you see demand, which obviously the Fed is trying to slow demand, when you see that container import number is rolling over a little bit, I think that's a good takeaway in my opinion. As we alluded to before, there been continued credit growth out there. Banks are still lending, and they're lending to build multifamily. Obviously, there's people are building a lot of single-family homes too, but this divergence is pretty interesting, and I think it speaks to several different themes. Obviously, there's this work from home thing that is still out there, even though we're getting back to some hybrid environments and people are spending half the week at home and half the week in the office. Well, it's making people think a lot about investment in office. But conversely, the housing sector with the years of underdevelopment, there's clearly an interest in the fact that the credit is available at this point in time, which again, as I said before, is extremely unusual. If you feel like you're on the doorstep of inflation, that's not the case. That lenders are worried about credit quality. They're worried about, obviously, basically worried about getting repaid, and so they tend to constrict credit. Well, that ain't happening right now, and a lot of this is going into multifamily housing, which again, I think will help us at a lag. It'll take time, but as these new units come online, it'll help to drive rent a little bit lower, helping our CPI problem. We'll talk about earnings here real quick. And you got two lines here. You've got in the red line, it's the consensus estimate for the S&P 500. And the blue line represents what that red line looks like if you back out energy. And we know energy had a great year last year. Earnings were high, expected to continue to be high. But, the rest of the market, I think there are pockets of the market, obviously, that I think are in or near kind of an earnings recession. And see that dark line, that blue line here, rolling over a little bit. And so this is the big what if this year. What are earnings going to do, right? And so, but when you think about input costs, and again, this is what the market expects right now. And I think we'll get first quarter results. And we're going to learn a lot about what's going on. We're going to hear from CEOs. They're going to talk about their environment. I think analysts will reassess at that point. And that point will probably be over, the coming, 3 to 6 weeks. And, you may see some changes here, but just think about the inputs. What goes into earnings? Sales, obviously the mother's milk of all earnings. That will be very important. But from a margin standpoint, think about this. Shipping costs going down. We just saw container costs going down. Logistics costs are going down. We see also, we see cost inputs, commodities, industrial metals, and things like that off of their peaks, which is all helpful. And then obviously the most important thing outside of all of that is going to be labor costs. And if you see labor costs continue to roll over, even though the year-over-year number is still high, but if you see some moderation in that, that's all helpful for earnings and could lay the groundwork. And I'm not saying it's going to happen, but it could lay the groundwork for some positive surprises where at the end of the day, when we have all of these first quarter results in the bag here, after probably about, late February, we may look back and say, wow, these fourth quarter earnings were actually a lot better than we thought they were going to be. So, again, market loves positive surprises, hates negative surprises, but there's a lot of subplots here that need to be parsed. So here's a chart of earnings. And so the blue line represents consensus analyst estimates, and then the rest of this represents historical data, and it goes back to 1988. And just as you would normally expect, in an expanding economy, that earnings go up over time. Yes, it's well understood. Obviously in 2000, that wasn't the case. 2008, we saw those little dips there, but by and large, we see this slope. And so, the risk as it's perceived in the market now is that those blue lines are too high. But as I said, we're going to have to be careful about that particular assessment. I think it pays to be conservative and say, well, let's bet on the worst case and then hope things are better. And so I think that's where some people are right now. They're like, well, these blue lines really ought to be lower to be safe, and then let the market surprise us. And so, I do think that if there is a negative surprise, the market's not going to like that very much, because that may work to kind of re-rate the market valuation a little bit. But again, I think there are things and issues, and I guess what's the right word? There are elements afoot which might help to support the earnings argument for the next quarter or two. And the last chart for today is flows into credit. So these are basically flows into investment grade credit funds and also into high yield funds. And we haven't seen this activity in a while. For most of last year, people were running away from high yield, thinking, okay, we're going to have a credit problem. We're going to have defaults. We're going to have people that can't pay back their obligations. And so, people ran from that, and we had prices that moved lower as a result, and so what they call credit spreads widened out, but nowhere near what you would normally expect if you thought that you're staring a recession in the face. And because of that, it's actually interesting that people are now moving back into credit. It's almost like, you're seeing people that are saying, you know what, this wasn't so bad after all. And I think, we're going to eventually punch through this little volatile period and we're going to hit this new economic cycle. I happen to think that this is pretty bullish from the theory of maybe we get to this new cycle a little bit sooner. And I put a lot of faith. I've been doing this a long time, and I will always give more credit to the bond market for predicting these inflection points than I will ever give to the stock market. And the bond market here is telling you that they really don't think things are going to be too bad. That's it for this week. I really appreciate you spending time. I think it's a new year, and you have obviously new attitudes and new issues to deal with. I think most of us would be perfectly happy putting 2022 in the rearview mirror. But I do think that there'd be obviously some things that we're going to keep a close eye on, and not to say that these positive surprises are all going to manifest, but I think an active thinker is apt to be rewarded in this environment because honestly, it really is in the data. So have a great week, and we'll talk to you again soon.